Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's very important webinar on key considerations in audit of new age tech companies. The topic is very relevant and very important in these days. And in order to tackle this very important topic, we are having with us Dr. Devesh Prakashji. So on behalf of WSP of ICI, I extend my warm welcome to you, sir, on this very important webinar organized at June by WSP of ICI. Namaste, sir. Welcome, sir. Chairman, sir, has stuck up in, and Vice Chairman, sir, both are stuck in one of the meeting. So I'm taking this liberty to start this webinar. And before I start, it is my proud privilege to share with all of you the brief profile of Dr. Deveshji. Dr. Deveshji is a partner in E&Y Financial Accounting Advisory Services with over 25 years of diversified industry leadership role. He has over 25 years of professional experience gained from a multitude of sectors, but focuses mainly in banking and capital market and new age companies. He is PhD Certified Public Accountant CPA, Colorado, USA, MBA and CMA with experience in IQ advising, US GAAP and IFRS accounting reporting, enterprise risk management and change management. Dr. Deveshji is result-oriented and visionary professional with proven record of achievement in conceiving and implementing changes. He is inspiring leader and prolific speaker, innovative client-centric advisor with a collaborative mindset. Sorry. He is also a change driver on technological challenges. He is an artist, painter, and Indian classical singer. He is known as going beyond the traditional value protector mindset to help business improve stakeholder management and shift to a value creator mindset. List is very vast. So once again, it's a proud privilege to have you over here, sir. So thank you so much for acceding to our request, and warm welcome to you, and welcome to all the participants of today's webinar. So before I hand over to you, once again, I welcome you, sir. So over to Devesh, sir, for your deliberation. Over to you, sir, please.
Thanks, Anilji, for such a warm welcome. And I heartily welcome all the participants who have joined us today on a very important and relevant topic, which is on the auditing of the new age tech companies.
Yes.
So actually, India is celebrating the startup making in India. India is also celebrating the startup building tech trade in India. We are also celebrating the startup imaging the future of India. So from that perspective, we feel that this is the era and time of the new age tech companies. They are the real disruptors of the economy, and maybe few years back, we always thought that they will be having, these are just the buzzword and they will very soon vanish out of the trade. But now they are setting up the empires, and also the fact that they are taking the lead role in developing and shaping the country. India's entrepreneurship story is buzzing all across the globe and is being celebrated. And also the fact that global investors are also eager to invest in India. So Indian entrepreneurships are building the empires for India. India is a very vibrant environment, having the third largest the startup ecosystem in the world, with almost we have added about 20 new unicorns in the country, which is primarily the new age tech companies. So it is actually taking the pivotal role in the shaping and shining of new India, and India being a country having the potential of the enormous opportunity in terms of the consumption market, as well as the market which has a lot of tech companies growing into the space, and we can truly call that current age is a tech age. It is very opportune time when we are actually discussing about this. They have now moved into the mainstream business. They have challenged the established companies, and they are giving existential risk to these companies. They are the real disruptors. They are bringing the change. They are changing the game rather, and challenging the existing practices. So, and with evolving new ways and methods of solving the customer's problem. So something which was not possible maybe 5 years ago, 10 years ago, we are all seeing that. And during the pandemic era, we have seen these companies shining, and also the tech environment that they have built has helped us to sustain even in the challenging times. So these are the companies which are shining and shaping India. These are the companies which are solving the problem for the country. They are developed on the basis of uh, good business sense, and the companies which are having the real governance and compliance mindset are also growing very fast and rapidly. When we talk about the new age tech companies, we actually mean whole lot of companies, which could be the agri-tech, the fintech, the health tech, the e-commerce, the game tech. So there are enormous forms of these tech companies, which we are seeing as developing and growing in the current environment. So really, these are the companies which are going to be there in the long run, and shaping the growth trajectory of the country. So and government has also taken cognizance of that. And in fact, the startup growth that we are seeing, the new age tech company growth that we are seeing, is an outcome of the government's initiative of Digital India, which is helping the companies and consumers to digitalize the all possible areas and territory into the digital framework. The Atmanirbhar Bharat, which is primarily dealing with self-sustained growth in the economy, and model of primarily developing the country from the countrymen and by the countrymen. And also, our Prime Minister had launched the Startup India initiative as well, which takes care of not only the startup funding but also developing the startup ecosystem, right from training to providing all kind of infrastructure and sustainable growth in the market domain, to help the startup ecosystem grow and help the entrepreneurship grow faster than before, and reducing the red tapeism around the startup ecosystem, and also simplifying the requirements for the startups. So all these three initiatives put together has led to this growth that we are seeing in the country from the development perspective. And when we talk about the new age tech companies, there are a whole lot of people who are primarily helping these startup. When we call about ecosystem, it means the academia, it means the incubators, the support from the government, the investors and acquirers interest in the market, and also the idea and large corporates and intermediaries, and also the future entrepreneurs who are trying to be the aspiring entrepreneurs, moving into the startup phase and growing, and all the supports from media, influencers, and other ecosystem, including the banking system and global outreach. So this is the overall key ecosystem players and key audience. As I discussed about the fact that all these companies are coming up with the new advanced technologies, they are actually disrupting the market. They are understanding the customer problems. They are hearing what customer needs, and basis the customer needs, they are changing the game. So they are actually the changing the game, how this entire business is run, how the business is delivered, how the supply chain is developed, how the product is made, services are made and delivered. And something which we could not hear 10 years or 5 years back, everything is on your fingertips, maybe on your mobile set. You can deal with many of these companies. So it's really, they are the real challengers to the existing business players, and they focus a lot on data and analytics so that they can make their business decisions faster and they can have better outreach to their potential customers. And their business model is very different from the traditional model. And the big thing about these companies are they are new, they are agile, so they can very swiftly change the game and change the model. So when the COVID struck the country, then they changed their possible business models and delivery mechanism, and hence we could get a lot of things sitting at home even during the pandemic time. These companies also have a global reach, and certainly because of being agility, because of being new tech companies, because of the fact that they know the customer better, and they are setting up ground up. They are very high growth companies. They grow not in percentage, but they grow in multiples of growth of their sales, and they always overachieve their targets in achieving the growth trajectory from the revenue perspective. And conditions of new age tech companies have markedly improved because of high resolution venture finance industries. A lot of companies, VCs and Ps want to invest in these companies, and looking through the growth of various other companies, there are many entrepreneurs which are coming into the market and giving the tough time to the established players. And as we discussed, their speed to consumer adoption and new technology is unprecedented. They can make all these changes so rapidly, so fast, that an established player will take maybe a couple of years, but they are so agile that they turn it around within weeks. So and with almost very less cost, because they are agile and their size is relatively smaller, which is why their ability to make all these changes is very fast and very lean. The entrepreneurship as a own management science has been developed. We have seen a lot of people actually getting benefited by the growth of existing companies, which has led to many entrepreneurs to jump into their own business, their own startups, and then making the success coming true. So this is earlier people used to think that it will take several years and the chances of success was very low. But now we are seeing that there are a lot of companies which are getting into this space and making history by their new tech and new solution that they are able to provide to the consumers. And they can do all this at almost 1/10 of the cost of as opposed to an established players. So which is why their growth, their tendency to grow, and their tendency to adopt a change is much faster. And because of the government initiatives that we talked about, it is also helping them to improve with the help of government initiatives as well. The new age tech startup hotbed is primarily in US, and as we mentioned that India is the third largest in the startup ecosystem in terms of number of startups which have grown into the fact that how they have gone into the space of being unicorn is the fastest in India. And I guess there are so many countries in EMEAs which are actually doing good, but I guess India is the fastest among them. We have heard about the term unicorn. Unicorn is usually defined as a company with a valuation greater than 1 billion US dollars. There is a history to it, a very interesting one. When the Cowboy Venture founder Eileen Lee coined the term unicorn as a label for such corporate creators in November 2013. So it's fairly a newly coined term. It didn't exist before 2013. And tech startups have topped the 1 billion valuation mark. The total number of unicorn around the world is growing very rapidly. India, as we discussed, has shown close to about 20 new startups having reached the unicorn status, which is making India one of the fastest in the race and being third in the world in terms of total number of unicorns, especially in the new tech domain. So there are close to about 110 plus unicorns and growing. Each deal, we see a lot many tech companies getting into the unicorn status by way of new funding coming up. As you can see, there are, I mean, till December, there were 115 unicorns, but I think by the year end and by early January, there would be some more new unicorns get in making. And there are various very many unicorns coming up on this way. Sorry, there are so many terminologies which are very much prevalent in the new tech domain. So I thought maybe I will take 2 seconds to explain you all these terms in terms of what does all these terms mean when we and there are so many corns around. So this is actually a story of ponies to Pegasus, and the fact that there is a term called minicorn. Minicorn is the companies whose valuation is above $1 million, which is close to about 8 crores. So these are the companies which are called minicorn. They are in the ideation stage and as soon as an investor sees interest in these companies and makes the first investment, which we call Series A round, etc., that is when these companies evolve into the mini-corns. And the next stage that we see, we call them Sunicorns. Sunicorns are the companies where we say that very soon they will become unicorns. So which is why they are called Sunicorns. So which actually means that they are approaching, they are not yet there, but they are approaching to $1 billion valuation. And these are the companies which are going to shape the country, and government and public has a clear eye on them. They have potential to become unicorn and decacorns, but they are not yet there. And there are a lot of initiatives being made to develop this stage where the company which has already tested tasted the success in the market from pre-money stage, they are into business, and their revenue is rapidly growing, which is why their valuation is almost approaching $1 billion. There are various definitions, but generally it is understood that when we call any entity as Sunicorn, we presuppose that within 1 year their valuation may touch $1 billion, which is close to about 8,000 crore rupees. So these are the companies where the investors are very keen to invest. Their business is already tested in the market. The customers and consumers like their products and services. Then comes the stage where the company has already reached the $1 billion valuation. So this is pretty much well aware terminology. And once the company reaches crosses the 10 billion mark in terms of valuation, then we call them a decacorn. So primarily it is a valuation business, but at the same time, these are the companies who have actually not only grown in terms of their revenue, but also showing some sign of customer satisfaction, having the repeat orders. They are into money, they are into business, they are almost on the verge of profitability. They are either in the break-even stage or already started making profit, and they are EBITDA positive. These are some of the characteristics of decacorn, but I guess most important being that they are valued more than $10 billion. And then we have so many decacorns who have achieved the $10 billion valuation. And then comes the hectocorn, which is having close to about $100 billion mark. In India, we do not have any hectocorn, but very soon we expect that the companies who are already in the decacorn stage will get into the 100 billion mark. In US, the ByteDance and SpaceX are the companies who are in the tech company domain, have already achieved the status of hectocorn. In India, we are yet to see them, but we are very eager to have them in India as well. So far we discussed about the new age tech companies, and I must say that CA fraternity has a very vital role in the startup ecosystem. We help them to bring in the governance and compliance. And in order to have the sustainable growth, we have a very important role to play in this whole ecosystem of the new age tech companies. So now onwards, what we are going to do is we are going to deep dive into each of the specific areas with respect to auditing of these new age tech companies. What is the expectation? How we can help these companies grow and also meet their uh, uh, criteria of being growth oriented company, but at the same point in time, helping them into a very high growth as well as high on the corporate governance. We will see through what are the auditing challenges and what are some of the areas that we need to watch out while we are auditing all these new age tech companies. So now we will have a deep dive into each of those areas. And as I mentioned, we have a very strong role in developing, and auditing is very important for these new age tech companies. The audit report serves as an efficient tool for raising funds from the banks, financial institutions, from the private equity and the venture capital. So our report is something which is important for these companies. We ensure, or our audit ensures, the integrity and financial reliability because of being independent auditor. We provide the user of the financial statement the confidence that the financial statement are true and fair, and also the fact that we help in establishing the compliance. We ensure that the statutory regulation and law legal compliances are taken care in the company. And we also provide measures to protect the misappropriation of assets, ensuring the proper valuation of assets and investment. We provide the efficient audit system for implementation of internal control and minimization of possibility of errors and frauds. And we also provide the suggestion on with respect to improvement in operations. So in all, as I said, we have a very strong role in ensuring that the compliance standard are kept at the highest, as well as the growth is also not hampered. So we have a very important role in the development of these new age tech companies. There are several challenges as an auditor that we face while auditing the new age tech companies. There is a complexity of the technology and business model because they are the companies which are primarily a disruptor. They have the new age technology, the complex technology, and also the technology or model which was not existent in which was not have any existence in the past. So which is why many a times it requires a specialized knowledge and expertise to understand these technology and business models. They use a lot of new technology, and as I mentioned, this requires familiarity with the new technology within the auditor fraternity. The valuation of intangible is another area because many of these companies are into R&D stage. They build off a lot of intangibles as part of their development process. So there is a significant judgment involved in terms of getting the right valuation for all the intangible assets and the intellectual property. And also the fact that there's a lot of rapid changes in the business environment. They keep on changing very rapidly. Sometimes some of these companies were a startup with a particular objective and business model, and because of customer dynamics, they keep on continuously changing and evolving, which requires the auditor also to have a continuous monitoring of the risk assessment, and also understanding all the latest development that is happening in the company and how is it impacting the financial statement. And also because all these companies backbone is all tech technology, which means that the cyber security and other aspects are very important. Understanding the tech, understanding the risk related with technology, and ensuring the company's controls are in place and are effective to protect themselves from any of the cyber risk is certainly an area which is a challenge many a times for the new age tech companies from the auditor's perspective, so that there are no potential impact on the reliability of financial information produced by these new age tech companies. So pretty much, from the auditor's perspective, of course, our role is very important and significant in developing the new age tech startup ecosystem. But at the same time, auditor also do face a lot of challenges with respect to the technology and business environment related, including the cyber security, which has to be balanced out from the perspective of doing the right audit and ensuring the compliance are kept at the highest, and governance measures are being taken in the company. So there are various internal and external factors which drive the organization to reshape and relook their practices, posing challenges to auditors to keep up with the rapidly changing business environment. And very recently, because of the pandemic, a lot of these companies have seen drain in the talent and operations, which has impacted attrition, which has impacted their business model. So there's a continuous challenging environment. There is a lot of interest in these companies, and we see a lot of business combination related issues with respect to mergers, acquisitions, carve-outs or demergers, divestitures, and integration. And that also poses a lot of challenge for the auditors because each of these significant transactions have accounting implication and requires fair degree of assessment of each of the transactions in greater detail. Growing dependence on the investors, joint venture partners, and minority stakeholders also creates challenge from the auditing perspective. Increased market scrutiny and regulatory pressure it also keeps us on the toes while auditing the new age tech companies. Global drive towards delivery of digitalization agenda. Certainly all these companies have emerged because they have the new tech, they are building the new tech, they are building the nation, they are building or they are disrupting the entire market dynamics. So from that perspective, all these companies grow very rapidly, and all these fundamental changes which happens fairly quickly poses a lot of challenge from the auditor perspective. So if we look at the challenge for auditors, all these companies many a times do not have a very structured finance systems and processes, because they themselves are evolving. So if we are auditing a established company, as opposed to that, if we are auditing a new age tech company, there are various challenges in getting the first of all the right data, and also ensuring that they are accurate, they are complete. Many a times we get the data but which are non-standardized, and in ensuring that many a times it becomes difficult for auditor to begin their procedures. So we need to understand their entire systems and processes even before we look through and start working on the data provided by the company. So many a times, if we are tuned to work auditing the established company, there is a need when we are auditing all these new age tech companies to us also to evolve and understand their data much better. Although since they are the tech companies, so all the data is available, but we need to get the data in the right form and manner for us to use our accounting and auditing tools and technologies. And many a times there are significant manual data which is required to be received, which is received by the auditor, which poses the challenge to the auditor because of the risk assessment it becomes significant judgment, and as the risk increases, the substantive procedure also increase. So from that perspective, there is a lot of challenge while dealing with these companies. As we discussed, people is another area because of attrition. Somebody who has the knowledge and history of the company suddenly leaves the firm, and then we are dealing with the new person who doesn't understand the business and process of the company, and we are asking for the information and data, but we are not getting in the form and shape which we got last year. So these are another challenges, with practical challenges that we face while getting the data, and this poses a lot of challenge from the auditor's perspective. Sometimes there is a lack of right or sufficient skill set in the company, and high attrition further leads to challenge, and which leads to significant delay in auditing of these companies. So certainly, if somebody asks me what is the biggest challenge that you face while auditing a new age tech company, I guess the financial data is the one which is the biggest. Although they have all the data, but sometimes because of the business model, understanding the data in right perspective is something which is required from the auditor perspective. Now we move on to the real technical accounting area, which is very relevant from the new age tech company perspective. There are various areas that we have seen have posed a significant challenge while auditing these new age tech companies. So revenue is to be measured at fair value of consideration received. And many a times there are areas which are to be referred in greater detail. Many a times the revenue recognition policies, processes are not well documented, and also the fact that uh, every quarter they come up with the new solution, new uh, agreements with the customer, which poses the challenge of assessing and understanding if the right accounting uh, procedures have been followed, and if the revenue is recognized rightfully in the company. Many a times what we see, they have a lot of cash and non-cash incentives given, which according to the accounting standard is required to be netted off, but we see that it is not netted, but the revenue is grossed up. So that is one area which is very commonly that we have seen. The principal versus agent evaluation, because if we find that the entity is acting as a principal, then the revenue is recorded on gross basis. Whereas if the entity is acting as an agent, then in that case, the revenue is recognized on the net basis, and that significantly reduces the revenue of the company that we are auditing. And many a times the principles with respect to evaluation, whether entity is acting as the principal or agent, is fairly misunderstood, and which leads to grossing up the revenue, whereas the entity is acting as an agent in the transaction, which means suddenly the revenue which I have recorded at 100 rupees becomes a 7 rupee revenue. So that is the vast difference that it makes. If the company makes a margin of 7%, then suddenly your revenue that the company was thinking is 100 rupees becomes a 7 rupee revenue. So that is a very common area of pitfall that we have seen, and right evaluation with respect to principal versus agent is required. Ind AS 115 has a detailed guidance to assess whether entity is acting as a principal or entity is acting as an agent. There is a broad principle that while transferring the goods or services, who has the control over the goods or services defines whether the entity is acting as a principal or agent, and also which is to be backed by the three golden rules, which is whether the entity is operating in this transaction as the primary obligor, who has the latitude of establishing price, who has the control over inventory. So these are the three golden rules. If the company is not meeting any these criteria, then certainly it is acting as an agent. So that is one area which is very significant while auditing the revenue recognition. The other is multiple performance obligation. Generally, there are multiple performance obligation in the transaction. The accounting standard requires allocation of the transaction price of each of the multiple performance obligation, and many times it is overlooked, and the revenue is generally recognized in the first instance, the almost on the cash basis, disregarding whether each of the performance obligation is met. And if there are multiple performance obligation, then revenue should be recognized for each of the performance obligation whenever each of the performance obligation is met. So assuming that there are, let's assume that there are three performance obligation ABC, but the company generally does record the entire revenue while the performance obligation A is met, while B and C is not met. So actually, accounting standard requires us to record the revenue for performance obligation A when the performance obligation is A is met, and B when the performance obligation B is met, and C when the performance obligation C is met. And the other challenge that these companies have is allocating the transaction price into each of those performance obligation. And the other area that we commonly see is revenue recognition point in time versus period of time. Many a times we see that the general tendency is to record revenue upfront, whereas it was supposed to be recorded over the period of time, or vice versa. So I think that is another area that is to be watched out from the revenue recognition perspective. We have also discussed about the incentives, but there are various incentives and discounts and warranty provisions, which many a times all the discounts are considered the variable of performance in incentives, which requires to be accounted for very differently as opposed to currently being recorded. Cost of acquisition or cost of fulfillment. So there is a specific criteria given in the standard, the contract acquisition cost and contract fulfillment cost, with respect to the fact that which cost can be capitalized and which cost should be expensed off when incurred. So if the criteria is met, only then the contract acquisition cost and contract fulfillment cost can be capitalized. Otherwise, it has to be expensed off. And there is a extensive disclosure requirement given in the standard. And while I am just discussing revenue recognition, but I think in general, what we have seen is while the companies actually do a startup, they start up under IGAP, and as their valuation grows up and their net worth crosses 250 crores, at that point in time, they look for Ind AS transition. So many of these companies are actually forced by their investors to get on to the Ind AS by early adopting, because they find that Ind AS is more consistent from the perspective that if the company is looking for any overseas listing, or for that matter in listing in India, that is anyway required. So from that perspective, generally investors do persuade these companies to early adopt Ind AS, and considering the fact that many of these companies, what they do is early on they try to pick up the Ind AS, and Ind AS conversion, whenever it happens, also creates poses the challenge with respect to understanding their business and understanding how the old IGAP versus Ind AS 115, what are the challenges with respect to adoption, and various requirement of Ind AS, how to meet, and with respect to transitioning to Ind AS, how do we adopt the company's Ind AS following the Ind AS 101. So from the revenue recognition perspective, if we look at key assertions which are important, is existence, completeness, valuation measurement, and also the presentation and disclosure. So from the risk of misstatement perspective, the auditor needs to ensure that revenue recognition is in accordance with the relevant accounting standard. If the company is following Ind AS, then the principles of Ind AS 115 of the revenue recognition and is recognized, and recoverability of related balance is taken into consideration. Risk of proper revenue recognition due to management overrides on control over cutoffs. So from that perspective, the company needs to do the complete process walkthrough to understand the process of revenue recognition and monitoring of accounts receivable. Company also needs to look through the revenue recognition checklist, review all the arrangements, including the one which are reviewed in past, from both initial and amendment perspective. If there was any amendment that has taken place, if that amendment has resulted into the change in any of the understanding, then revenue is required to be appropriately recognized in light of the changes in the contract. The sales incentives, discounts, all variable considerations for revenue are recorded correctly. There is a specific guidance with respect to how the variable considerations are required to be accounted for in line with Ind AS 116. So from that perspective, the company needs to ensure that the revenue is recognized appropriately, and revenue is also recorded if it is recorded prior to service provided. So all those things can be met while performing the process walkthrough or performing the test of detail for sales transaction, performing the substantive analytical procedures for revenue to the extent practicable and relevant basis of based on all the available data. So from the completeness and presentation and disclosure perspective, there could be a risk of inappropriate provision of sales return being made, arrangement that could include multiple performance obligation not correctly allocated based on the fair value of each of those elements, or for that matter, increase in revenue due to management overrides and control. And for that, auditor can analyze month on month sales to understand the variance in the sales trend, check out for the unusual trend, and also verify revenue from the financial statement and trace it back to revenue reported in under GST returns. Allocation of fair value within the multiple element arrangement, including post-contract customer support, is also required to be reviewed, and ensure all the applicable disclosures as required by Schedule 3 and accounting standard are being made. So from the revenue recognition perspective, if I summarize from the auditing perspective, I guess two important things to note here. One is there is a specific guidance given in Ind AS 115, which deals with each of the areas, whether it is related to variable consideration, whether it deals with the principal versus agent, whether it deals with any change in accounting or a change in the agreement, or establishment of new product and services. So all of that can be managed from the audit perspective by way of appropriate planning for the audit, and also ensuring that all the procedures with respect to walkthrough and also the analytical procedures and going through all the significant contracts and contract modification is certainly which are some of the key considerations while doing the revenue recognition accounting. If we move on further, the accounting for lease transaction, it is another area which has undergone a significant change in very recently, and we have seen a lot of misstatement being made or lack of understanding from the company perspective with respect to lease accounting. First of all, identifying the lease itself, changes to the system, the company's implementation plan, and peer comparison, the disclosures, the right number of resources and skills required, communication to of the impact, and looking through the contract modification, and also impact on key financial metrics on the financial statement, because under the new lease standard, which is Ind AS 116, as opposed to the operating lease accounting, most of the accounting, if I talk on from the layman perspective, becomes a finance lease from the accounting perspective, and that creates a significant change in the financial statement, that each and every balance revenue lease agreement gets onto the balance sheet by way of right of use asset and lease liability. And it also poses additional challenge if there is a sale and lease back transaction. So there are various challenges with respect to lease accounting. The key assertions which are relevant here is existence and completeness, valuation and measurement, and presentation and disclosure. And the significant risk of misstatement could be the entity not identifying all the arrangement that are leases or contain a lease. Ind AS 116 is not appropriately applied to determine whether the contract contains a lease or there is a separate lease component, which are not properly identified of the underlying asset. And then there are variable payments not appropriately calculated and recognized as part of consideration in the contract during the period of contract. So from the key audit procedure perspective, obtaining the list of all the contracts, all the existing contracts, all the new contracts, all the contracts which are modified during the period, and then testing the completeness of the list, considering performing the inquiry of internal stakeholders, be it legal, finance, operations, procurement, to identify the contract that may be lease or contain the lease. Many a times what we feel is that there is no direct mention of the lease agreement, but many a times when we look from the accounting standard perspective, that may contain a lease. So we need to provide perform all these inquiries, and if we find any discrepancy, we need to resolve that. And for all the significant new contracts or the contracts which are modified, we need to evaluate that if any of those contracts contain lease transaction, and also review terms and conditions underlying the contract to test the management identification of lease and non-lease component. And if the practical expedience is taken into consideration by the company, then ensuring that the company has appropriately applied the practical expedience by the class of asset. and testing all the leases from that perspective. Auditor also needs to obtain the management's analysis that documents in the consideration in contract for each of the new lease. If I may summarize, then of course I think the significant level of work is required by the auditor to check if something that contains a lease but was not considered lease by the company, then that is an area which is to be um, watched out for. And also, if there is a practical experience taken by the company, then each of the practical experience is adopted consistently by the company, and also ensuring the completeness by doing the inquiry and ensuring all the required disclosures are made by the company is some of the key consideration from the auditing of lease accounting perspective. If I may move further from the leasing perspective, there could be a challenge with respect to lease not accounted on the date of commencement of lease. There could be challenge with respect to lease term defined incorrectly or determined incorrectly. There could be an option of extension, termination, and purchase and not evaluated properly. There is a guidance which is issued by ICAI, which is a very thorough and detailed guidance with respect to and with each of those scenarios mentioned therein, which is sometimes becomes very handy for the auditors. So I highly recommend that we follow the guidance note both on the revenue recognition and leases issued by ICAI, and many a times we have seen that there is a requirement of reassessment of lease term or purchase option not appropriately accounted for and identified. For that purpose, there may be understanding is required by the auditor whether there is a non-cancelable term in the lease and whether there are any options available with respect to extension, termination, and purchase bargain purchase option, and whether it is taken into consideration while accounting for each of those areas, and then determining whether the evaluation considered is corroborated along with the relevant fact pattern in terms of assessing whether the entity is following the relevant practices both from entity and market perspective. And then testing that the lease payment and discount rate used are taken into consideration in line with the contract terms itself. So these are the areas which is required to be watched out while auditing the lease accounting in the company. So if I move ahead, then another very significant area relevant for such company is the accounting of internally generated intangibles or auditing the R&D expenditure is another area that we see many a times the new age tech companies actually grapple with. There is a specific guidance that the research phase, all the cost is required to be expensed as incurred, and development phase expense is only capitalized if the criteria given in the standard is met. Otherwise, everything else by default is expensed. And also internally generated intangible, if there is a proper documentation is available, then auditor, depending upon the company entity meeting the criteria, recognition criteria of the intangible, there is a in-depth analysis required to assess whether the recognition criteria is met, and also the fact that whether there is a proper documentation which is auditable is available with the company. So many a times there is a lack of documentation, which many a times result into expensing of all these event developmental phase expenditure, because the company is not able to uh, showcase the required documentation, ensuring that the recognition and eligibility criteria is met. And in the event that the auditee is not able to provide the data uh, and also its assertion, then by default it will result into the expense recognition as opposed to capitalizing such intangible assets. So what are, I guess the key assertion here is existence, completeness, valuation, and measurement. Key risk of misstatement is analysis and separation of research and development phase is not appropriate. The company is not able to analyze when the research phase is over, and when what is the cutoff of end of research phase and what is the cutoff of the development phase. The inappropriate charge off of the expenses that should be considered while capitalizing the intangible asset, or inappropriate capitalization of expenses that should be considered to be charged off to income statement, or an inappropriate impairment or amortization of intangible assets. So how do we assess as an auditor? What are the key audit procedures that we need to perform is obtain the schedule of intangible asset, that test the basis of addition, amortization, and disposals are recorded, examining the invoices, authorization, contract agreement, the other data supporting the ownership and of the intangible asset capitalized, understanding when is the research phase got over, what is the documentation available with the company to assess the research phase is over, and the development phase has started. When did company actually achieve the commercial viability of product which is being developed, in order to ensure that the company has actually moved from research phase to the development phase. So all of these things actually require robust documentation on the part of the company, and failing which all the cost is required to be expensed off, because the requirement is that it should meet the recognition criteria, and also the fact that there should be proper documentation, auditable documentation, to prove the point that all the required criteria for recognition of development expense, development phase has been met. Management also needs to evaluate the capitalization of pre-launch inventory based on the completion of trial and regulatory approvals, and also review the minutes of the agreement of the existence of the intangibles, the existence of an evidence of lien, pledge, and security interest over intangible, over and above understanding the business to whether the recognition criteria of the intangible is met or not. So overall, I think this is one of the significant and tricky area, which requires significant audit procedures to be performed, and also require a significant work of documentation from the management part to ensure that the auditable evidence and documentation is provided to auditor to ensure the fact that all these criteria given in the standard is met. This is another very significant area because we have seen many cases where the company thought that it is only issuing equity shares or issuing the CCPS. So by and large, from the firm perspective, they actually are the equity, but with the existence of the specific clauses in the agreement with respect to buyback or conversion feature, etc., it actually becomes a liability, and which means that something which was accounted for as an equity becomes liability. And not only it is a classification change, but it also makes a big difference and then to income statement, because of the fact that if it is a liability then or a debt, then in that case the imputed interest is required to be computed, and that hits to the income statement and accretes to the liability. So this is one area, because we have seen several such SHA, shareholders agreement, and term sheets where actually this problem was found and would actually require the company to change its classification and will have a significant drain. These are the facts that happens because of lack of understanding of the accounting standard, and once the transaction is consummated, then nothing can be done, but it has to be accounted for as a liability. So from that perspective, I guess it is very important for the company to look forward to such tricky clauses in the agreement, and many a times these agreements are signed up by the private equity or the venture capitalist or the investor in the company, and without understanding the repercussion, these standards, these agreements are repeatedly getting signed, and having a significant drain in the income statement, and also a significant change in their balance sheet from equity to liability perspective. So this is one of the very significant area which is to be watched out by the auditor, because many a times, because of lack of understanding, many of the companies have not understood the accounting standard wisely, and resulting into these things caught up by the auditor and requiring to significantly change their accounting, both from the recognition and measurement and presentation perspective. So this is one very critical area, I would say. If I were to rate, I guess the first one being the equity transaction, and then second could be the revenue recognition, because these are the two very significant areas where we have seen that there are chances of misstatement and misunderstanding of the standard itself, resulting into significant deviation from the accounting standard perspective. So I was talking about debt and equity classification. Many a times, the fact that there is a buyback clause, that in given event, the company, if the target is not met, then the company will buy back the share from the investor. That is one area, although this is a significant technical area, so I will not would like to give any judgment here. But what I say that is, if there are any such buyback provisions, it requires significant accounting assessment, both from the company management and auditor perspective, so that the risk of misstatement is mitigated. And if there are any element of buyback provision, then most likely scenario could be that it will become a liability as opposed to equity. But having said that, the devil lies in detail. Just having the buyback provision doesn't result into debt or equity classification. We also need to see whether whether the buyback event is in the control of the company or is not in the control of company. So what I'm trying to hint here is that it requires significant judgment, and it is highly technical area from the accounting perspective. So one area we need to watch out is the buyback provision. The other area, which is the conversion feature, if there is a fixed to fixed criteria, then the accounting is different. And if it is fixed to variable, the accounting is different. So most likely understanding what is fixed to fixed and fixed to variable is also very significant and judgment. There is a specific detailed guidance given in standard. If we apply it correctly, then we can actually minimize the risk of misstatement by the company. By and large, if I have to define, then fixed to fixed is generally would mean that if I have to convert the share from one, let's say CCPS converts into one equity shares, then it becomes a fixed to fixed. But if I say that one equity share will get converted into 100 rupees, then it is not fixed to fixed, it becomes fixed to variable, because it is not in the ratio of the shares, but it is in the ratio of the fixed value. And again, this is an area which is to be looked into greater detail. There is a specific detailed guidance given in the standard, which requires us to get into the bottom of the detail of the transaction. Only then we are able to assess and advise the client as to what is the correct accounting outcome of all these elements present in the contract. Similarly, the warrants, the stock options, the compulsorily converted shares and debentures has significant accounting and auditing procedures requirement. The non-cash equity activity won't appear on the bank statement, and funds received on various forms, which would impact the net asset position and debt equity ratio of the company. So all of these things are very important from the auditing of the financial statement of the companies. And you will see that 9 out of the 10 new tech companies, you will find all these clauses that we just mentioned, or that you see on this screen. So from that perspective, all these areas are required to be watched out for, get into details. We need to do the significant assessment of each of the shareholders agreement and term sheet to ensure that we are not missing out on some of the very important and significant transactions existent in the auditee's financial statement. So from the key assertion perspective, I guess existence, completeness, and valuation and measurement are some of the important area. The risk of misstatement could be the beneficial conversion features not identified and accounted for correctly, or the contingent obligation rights in the financial instruments, debt and equity classification not done correctly, any buyback provision not understood correctly and resulting into actually a debt recorded as equity, any conversion feature which is incorrectly evaluated, resulting into bifurcation or separate accounting. There could be a outcome that it is a hybrid financial instrument as opposed to even a debt or equity. So accounting outcome could be equity that we accounted for as a debt, or vice versa, or could be a hybrid instrument which is having bifurcation requirement to record for debt and equity separately, following the right accounting procedure for each of the class of transaction. Then any embedded feature which require to be identified separately, which we call embedded derivative. So if there are embedded derivative, then if it is not clearly and closely related to, then it has to be accounted for separately, and there is a specific guidance with respect to what does the clearly and closely mean, and that results into a different accounting outcome, which requires it to be bifurcated into the base agreement, and also assessing whether the embedded feature, which is generally a derivative, to be accounted for and detached and accounted for differently in compliance with the accounting standard. So what are some of the key audit procedures that we can perform to ensure that the chances of misstatement is taken into consideration? Could be review of the all applicable documents related to financial instruments, understand and read all the SHAs and term sheets, understand all the terms and condition, and these are generally very lengthy and 50 to 100 pager document, and we need to go by line to understand, because any slightest change in the agreement would result into a very different accounting outcome. We have seen in practice merely changing a few words will result into a different accounting outcome. Complete the financial instrument and related feature and debt equity class characteristics identification and consideration checklist has to be filled in, and then document the accounting for transaction as researched by the appropriate personnel, document the formal technical accounting white paper and independent third party to determine the fair value, reliance on the work of the expert here, and ensuring the financial instruments and related feature of debt and equity characteristics in case of embedded derivative is taken into consideration. So as I said, this is one of the most significant area while assessing or auditing any company, especially the new age tech company. And as I also mentioned, that 9 of the 10 companies, you will find these tricky clauses which will result into a very different accounting outcome. Improper cutoff and receivable and generally what we have seen, policies and controls regarding cutoff dates are not defined, reconciliation are not done on timely basis, the risk of missing expenses, transaction may be recorded in the wrong period. Common contributors for the issues including lack of proper accounting policies, inconsistent practice are some of the common areas. Key assertion checked here is existence and completeness. And risk of misstatement is transaction or event are not recognized and recorded in the correct period. The key audit procedure that we can perform to ensure that the accounting is done appropriately could be performing the understanding of entities, the revenue recognition policy, cutoff date policy, cutoff of all the uh, expenses, understanding the accounts payable flow, performing all the walkthrough, performing test of details of transaction near the cutoff date, first 5 and last 5 days, validation of calculation of cutoff adjustments, reconciling the goods dispatched or services provided notes along with the invoices, ensure the invoices of goods and services dispatch notes pertaining to the same accounting period, review and ensure that date of purchase invoice and receiving notes are the same. So there are a lot of procedures which are required to be performed to ensure the cutoffs are taken into the right perspective. Acquisition is another area which is very common in new age tech companies. Either they acquire somebody or they are acquired by somebody. So because there is always a consolidation process which keeps on going whenever the company gets into a sizable space. So there are multiple factors which are to be assessed here, that accounting for the business transaction is most frequent source of error in financial statement. Acquisitions are complex and requires complex assessment for the acquisition accounting. There is an element of common control here, which could result into a very different accounting outcome. The business transaction has significant influence in the group's financial position, resulting into change in operations, and accounting for transaction at the inception as a considerable impact in the future accounting. Understanding the right purchase consideration, understanding and relying on the work of effort of the valuation who is doing the purchase price allocation. There are various considerations with both pre-deal phase or maybe contracting phase or maybe implementation phase or maybe post-implementation phase, and each of the time company needs to do the assessment of the right acquisition accounting. Each of the type of transaction, whether it is some sale or it is a demerger, whether it is a merger, these are all very complex accounting area, and which makes it a very complex auditing area as well. There is a significant work involved if any of the business combination related transactions are consummated in the company from that perspective. Some of the questions checked here are existence, completeness, valuation and measurement, presentation and disclosure. The risk of misstatement is evaluation of business versus asset acquisition. The company may assess that it has acquired as only the asset and not the business, and do the business acquisition accounting or vice versa could result into significant change in the accounting. determining the acquisition date, determining the accounting in line with Ind AS 103, fair valuation of the assets are being made correctly, and then also if the entity which is following Ind AS acquires an entity which is following IGAP, then post-merger the company's financials are to be performed as per Ind AS. So a lot of such consideration from the accounting and auditing perspective. Some of the key auditing procedure could be verifying the business acquisition agreement. If the company is going through demerger, then understanding the demerger process, and if it is happening through NCLT, providing even the NCLT documentation, providing the accounting scheme because that is required to be provided by the auditor of the company, and then verifying the purchase allocation report obtained, purchase price allocation report obtained from the valuer, verifying the acquisition entry posted by the company, involving the valuation expert team for review of valuation of intangible assets and goodwill and underlying assumption, and also reviewing the ancillary agreement performing part of BTA, and post acquisition testing the impairment of goodwill, etc., in line of the changes happening in the business and business model and the environment of the company. So significant area of audit. So if I were to rate, I guess number one being the debt equity classification, number two revenue recognition, and third is business combination. These are the most trickiest and also requires procedures to be performed by the auditor while auditing the new tech companies. This is one of the very significant area from the audit consideration perspective. Then moving on, the additional areas to be looked out in the acquisition accounting perspective is accounting of the contingent consideration, understanding the tax impact, understanding the consideration in itself. It is if it is happening by way of cash and also by way of equity or liability. So all of that has to be properly verified by the auditor, verify the basis of recognition of goodwill, verify the amortization calculation of intangible assets, trace the value of the intangible assets recognized to PPA report, verify the appropriate disclosure in the financial statement, because user of financial statement would watch out for any significant acquisitions or business combination happening, and the financial statement is the only source of getting such information. Review of the consolidation journal entry related to PPA and its correctness is another area which requires significant auditing effort from the auditor's perspective. ESOP accounting is another area, and I will briefly talk about it. It is a very detailed assessment which we talked about, but I will talk about one of the significant auditing matter, which is understanding whether the and it is a very common for the new age tech company to have the ESOPs, because this serves as one of the significant method of employee retention and retaining the talent in the company, which is why these companies tend to have ESOPs granted to the employees. And many a times I have seen The fact that these transactions result into a significant judgment with respect to whether the ESOPs which is granted is cash settled or equity settled, because accounting is very significantly different versus equity settled versus cash settled. Because if it is cash settled, then the accounting happens on the grant date fair valuation over the vesting period. But if it is cash settled, then it is treated as liability on day one, and each time period the liability has to be reassessed each balance sheet date or each reporting date. The balance sheet, the liability has to be reassessed, and it is no longer recorded on the grant date fair valuation, and it has a significant impact in the company's financial statement, and also it brings in a lot of variability in financial statement. So from that perspective, it is one of the very significant area uh, which is to be watched out from the ESOP accounting perspective. And we 9 out of 10 companies we will have the ESOPs in the tech companies, and generally they are issued as equity settled, but in order to give liquidity to the company, because they are not listed, many a times they do the cash settlement on a periodic basis or on the exit, and that makes equity settled uh, ESOP transactions a cash settled transaction, because by way of the construct or the form, this is equity settled ESOP, but by way of performance, it is being settled in cash. So this is another area which is to be looked into greater detail. Key assertion which is tested here is the existence, completeness, valuation, and presentation. The risk of misstatement could be cash settled, accounted for as equity settled, and share-based payment expense incorrectly calculated, inappropriate details considered for the valuation perspective, share-based payment expense is recorded in wrong period, and inappropriate disclosure leading to wrong user information. Some of the key audit procedure that we can perform to mitigate this risk is review the details of ESOP issued on a sample basis and verify the grant letter. Look at the performance of the company, as in whether the company issuing the equity settled transaction, but actually and practically settling by way of cash. So even though in form it is equity settled, but in practice, if it is cash settled, then from the accounting perspective, it will be recorded as cash settled transaction. Review the assumptions used in valuing the share-based payment. This is another area where we have seen that sometimes the assumptions used are not appropriate, which is not in line with the company and the environment in which the company is operating. So that also is one of the significant auditing area. Analyzing the appropriateness of accounting in line with Ind AS 102, verifying the number of options issued and vesting period from the grant letters. So each grant letter has to be verified, obtaining the valuation of stock options, reliance on the work of the expert, review and recompute the ESOP cost, and ensure the appropriate disclosures are made in accordance with the relevant accounting standard and Schedule 3 of the Companies Act. So these are some of the key areas of audit procedures to be performed by the company. And as I mentioned, this is also one of the significant area from the audit consideration perspective. Moving ahead, I guess the going concern assessment is another area which is to be watched out for, because many of the new age companies are raising equity and debts, and since they are in the growth stage, not many are actually EBITDA positive. understanding their cash flow forecast, disclosure of material uncertainty, etc., are some of the area from the auditing perspective which is very relevant. Key assertions tested here is existence and valuation and measurement and presentation and disclosure. The key risk of misstatement is alert for the factors that may cast significant doubt on the company's ability to continue as a going concern. Significant debt and other commitment raising the concern of the going concern. Impact of the significant losses, impact of pandemic. So key audit procedures required to be performed here is making inquiry with management on the impact of pandemic, review of the going concern assumptions and recoverability of assets, review if the company has adequate liquidity position to fund its operations, use the balance sheet during the scope and strategy to determine whether the entity is net liability position, investigate the significant liability, especially those due within the period covered by the management assessment, and inquire with the management regarding its plan to satisfy the obligation. So overall, understanding the entire business model and understanding if the company is performance with the previously shared business model, and if there are significant deviation, then reassessing whether the company is actually there is company should be accounting as a going concern or not. There are internal control challenges, and considering that these are newly developed companies, many a times we see the deficiency in internal controls. There's lack of segregation of duty, lack of adequate supporting documents, which sometimes makes auditors position very difficult for performing the verifying the existence of the transactions, completeness, procedure performed, and controls are in place, oversight and review, and ensuring that the aspect of fraud prevention and detection is taken into consideration. User access of the information system is another area which is an area of concern because of lot of ad hocism existence in the growing stage company. Significant class of transaction. Scots, I guess we have discussed all the significant significant class of transaction. This being primarily the financial statement closure process. It could be leasing, it could be revenue recognition, it could be related party transaction, it could be acquisition related transactions, it could be ESOP related transaction. So from the auditing procedure perspective, walkthroughs performed to confirm the process consistency, test of control performed using the significant population, controlled efficiency, communication to management, update test of control process in light of the post-interim testing, and for the fraud risk, reperformance of test of control for the period. So from the risk matrix perspective, the auditor has to understand what is the significant risk, which is the inherent risk with higher the likelihood of the occurrence of higher magnitude of potential misstatement in the financial statement. So detailed planning is required in light of the fact that how the company is taking into consideration all the key areas and key processes to ensure the minimization of fraud and significant risk. Entity level control is another area which is to be assessed by the auditor, and another area from the auditor's perspective while auditing the high growth companies. And accounting and disclosure, we have touched upon on the significant accounting disclosures by way of each of the accounting standard that we have covered during my session today. And this is my favorite slide, which is thank you. And I am happy to take any question if you may have.
So can you hear me?
Yes.
Sir, there are certain questions we are fetching, our technical team is fetching. So first of all, sir, thank you so much for a wonderful deliberation. It was really wonderful and a very detailed manner. You have covered almost everything relating to this, that is relating to the audit consideration, audit part. And you have covered everything from meets various standards also, like going concern, materiality. You have covered all aspects relating to that in your presentation, sir.
Thank
And
you very much.
on behalf of AASB of ICICI, I extend my heartiest thanks towards you for sparing your valuable time. Our technical team is still in fetching these questions, but due to some technical glitch, we are unable to fetch the questions from the members. But we soon we will receive the questions. Then I will mail you, sir, all the questions, and accordingly I will forward the questions, your answers to the concerned members, sir.
Thank you.
Fine. Fine, sir. So once again, sir, thank you so much for acceding to our request on a very shorter notice, and thank you so much for enlightening all of us on various auditing aspects while auditing the various key consideration while auditing the tech companies, tech new age companies, sir. Thank you so much, sir. Thank you so much.
Thanks, everyone. Thanks to the
Thank you.
participants for their valuable time. Thanks, everyone.
Thank you, sir. Thank you, sir.